Hello, welcome to my channel once again. So I'll be talking about the non-discounted cash flow techniques or investment appraisal. Even though I've talked about one of these in one of my previous videos, that is the payback period. So I will speak a little on this and talk more about the accounting rate of return. Now, talking about the non-discounted cash flow techniques of investment appraisal. This is a technique, or these are techniques that we use to evaluate investment projects without adjusting future cash flows for the time value of money. The focus on the non-discounted cash flow is on nominal cash inflows and outflows, and they are simpler to apply, though and sometimes they can be less accurate for long-term projects. So the non-discounted cash flow technique is a traditional method of project evaluation that does not consider time value of money. So the techniques under the non-discounted cash flow include the payback period and the accounting rate of return. Payback period and the accounting rate of return. I'll talk more about the payback period in one of my earlier videos. But in synopsis, when we talk about the payback period, we are actually referring to the period that is usually expressed in years, which it takes cash inflows to equate cash outflow in capital investments. The payback period is often used as a first screen process in order to determine the years it will take a project to recoup the initial investment. So payback period is usually a measure of liquidity. That is how quick the company can recover the initial investment on the project. So it should be noted that payback period is based on expected future cash flow and not accounting profit. So the payback period measures how long it takes for the initial investment to be recovered from net cash inflows. So the formula can be determined in different ways. It's cash outflow divided by what? Constant cash inflow. In other way, it can be said to be initial investment, which is an outflow, divided by the annual cash inflow, if uniform. And where it is not uniform, where we don't have the regular cash inflow, we apply a tabular approach. That is where there is irregular cash inflow. The payback period can be calculated using a table where we have the years, the cash flow, then we have the cumulative balance. You can watch my earlier video to see more of these. So the other form of the non-discounted cash flow I want to dwell more on is the accounting rate of return. The accounting rate of return. Now, when we talk about the accounting rate of return, we are referring to the average accounting profit to or average investment or average investment. This accounting rate of return can otherwise be referred to as return on investment or return on capital employed. So the accounting rate of return is used to measure accounting profit, is used to measure accounting profit, or is a non-discounted method that makes use of accounting profit that is shown in a company's financial statement. So it is also known as return on investment or return on capital employed. So the accounting rate of return is the minimum return expected by investors from its investments. So accounting rate of return is a measure of profitability in that it focuses on profits and not cash flow. So similar to the payback period, when cash flows are given, it should be converted to accounting profits before accounting rate of return is calculated. So there are quite a number of formulas we can use to determine that in calculating the accounting rate of return. This formula is very important. That is the estimated average annual profits divided by estimated average investment multiplied by 100 over 1. How do you get your estimated average investment? It is your initial outlay plus your residual value in terms of investment divided by 2. And your annual depreciation is what? Is your initial outlay minus residual value divided by the useful life of the project. And so also, how do you determine your accounting rate of return? It is this formula where you have your estimated total profits divided by estimated initial investment multiplied by 100 divided by 1. Now, you must note this. Cash flow is accounting profit or loss plus depreciation. For you to get your accounting profit, it is cash flow minus depreciation. In that way, you can determine your accounting profit. Now, you must note this. You must note this in trying to solve questions on discounted and non-discounted cash flow. What do we mean by independent project and mutually exclusive project? I put that the independent project are projects that can be accepted or rejected without affecting the decision on other projects. For example, that a company might consider launching a new marketing campaign and investing in a new product line. So these projects are independent. The decision to pursue one does not affect the decision to pursue the other. And also, we can have a case of mutually exclusive project. These are those projects where accepting one automatically means rejecting all others. So this is a situation where only one project from a set can be chosen. For example, a company might be considering two different sites for a new factory. Choosing one site means that the other is not visible. So you must note this and be able to differentiate between these two. Now, when you're trying to make a decision in relation to accounting rate of return for independent projects, what do we do? Accept if the accounting rate of return is greater than or equal to the management predetermined accounting rate of return. There will always be a set standard by the management. So once you compute and your accounting rate of return is greater than or equal to the management predetermined rate, you accept. For mutually exclusive projects, your decision rule will be based on the fact that you accept any project with higher accounting rate of return, provided it is greater than or equal to the management predetermined accounting rate of return. So we have this example that Samsung Limited has a targeted rate of return of 22% and is now considering the purchase of an asset with the following information. Now, we have the initial investment, which is the capital outlay to be 85,000 naira. The estimated profit before depreciation, take note of that word, before depreciation. It means this is a cash flow. It's not yet an accounting profit because depreciation is still part of the profit. So in year one, we have a profit of 18,000, year two, 25,000, year three, 38,000, year four, 45,000, and expected residual value, that is scrap value, is 2,000. Require, calculate the accounting rate of return on the acceptability of the project. Now, I've shown the working, my slide. Now, for you to calculate that, you must know what your annual depreciation is, because for you to get your accounting profit, you must deduct depreciation from each of these profit elements here. This is still cash flow, not yet accounting profit, because depreciation is still part of it. But for you to get your accounting profit, you have to less depreciation, and hence the need for us to compute our annual depreciation. The initial outlay of the project is what? 85,000. The residual value is 2,000, and the useful life of the project is what? Is 4 years. So you can see all these data here. So once you compute, what do you do? Once you compute 85,000 minus 2,000, you're going to have what? You're going to have 83,000. You divide that by the useful life, which is 4. You have 20,750 naira as the annual depreciation. Hence, with this, you can now determine your profit after depreciation, which will serve as your accounting profit. That is calculating profit after depreciation. So for year 1 to 4, these are the profits: 18,000, 25,000, 38,000, 45,000, respectively. The depreciation as computed is what? Depreciation as computed is 2750. So when you less annually, you're going to have a profit after depreciation. For year 1, we're having a loss of 2,750. For year 2, profit of 4,250. For year 3, profit of 17,250. And for year 4, profit after depreciation of 24,250. So these are our accounting profits. So what next are we to do? You need to calculate your average profit. The annual average profit is what? The total profit as computed here is what? 43,000. The average is what? Is 43 divided by 4, 10,750. So you now need to calculate your average investment. Your average investment is what? Is your initial outlay plus your residual value divided by 2. The initial outlay is what? 85,000. The residual value is what? 2,000 divided by 2. You have 43,500. Now, when you determine this, you can now substitute into your formula. To determine your accounting rate of return, the formula is what? Estimated average annual investment divided by estimated average investment multiplied by 100 over 1. So the accounting rate of return will now be 10,750, which is the estimated average annual profits, divided by the estimated average investment, which is 43,500, multiplied by 100 over 1. You're going to have what? 0.2471 in percentage, approximately, you have 25%. So the project accounting rate of return will be what? 25%. And it is higher than the targeted accounting rate of return of 22% set by the management. So the decision will be what? To accept the project. The target set by the organization is 22%. You can see it here. So when you compute, we are able to determine what 25%. So it's a good one, and we can actually accept the project. So also we have another example. We have another example here. We have another example, and the example is what? Osai Limited is currently considering 2 mutually exclusive projects. These are projects that are competing for same resources. The decision to accept one will affect the decision we'll take on others. So both projects are concerned with the purchase of new plants. The company made available the following data for the projects. We have the cost, that is immediate outlay for project A, 200,000, project B. We have it as what? As 120,000. And the expected annual net profit. Take note, the question can put cash flow. When it is cash flow, it means you need to determine your accounting profits. But in this case, it is clearly put annual net profit or loss. Year 1 for project A, 58,000. For project B, 36,000. For year 2, project A, we have a loss of 2,000, and for B, we have a loss of 4,000. For year 3, under project A, we have profit of 4,000, and for project B, 8,000. The expected residual value, scrap value now, for project A is 14,000, and for project B is 12,000. The company has an estimated cost of capital of 10%, and employs the straight line method of depreciation for all fixed assets when calculating net profit. The company has sufficient funds to meet all capital expenditure requirements. The management expected return on investment is 20%. 20%. We are required to do what? We are required to calculate the accounting rate of return and advise which of the mutually exclusive projects should be accepted. should be accepted. Now, with this now, what are we going to do? We need to calculate our annual average profit for each of the projects. Now, we have year 1 to 3, the summation of the profit for the various years is 8,000 for year 1. For year 2, we have it as what? As a loss of 2,000, and for year 3, profit of 4,000. In sum of everything, the total profit will be 60,000. The annual average profit will be what? 60,000 divided by 3. We have 20,000 naira as the average profit for project A. For project B, 36,000 minus 4,000 plus 8,000, you have a total profit of 40,000. The average value divided by 3, you have 13,333 naira. So now the average investment will be what? The initial outlay plus residual value divided by 2. I discover sometimes students get confused with this average investment. Students have asked, why are we not lessing? This is not depreciation. This is investment value at the beginning and at the close of the period. That is why we are adding. So don't get it confused. So initial outlay plus residual value divided by 2. If it is depreciation, to be divided by the useful life of the asset. In this case now, we're trying to determine the average investment, and that is why we're dividing by 2. So for project A, the initial outlay is 200,000 plus the scrap value of 14,000 divided by 2. Now 107,000 naira. Project B, initial outlay is 120 plus 12,000 divided by 2. We have 66,000 naira. All these values are in the question. This is it. Initial for A, 200, expected residual value 14 divided by 2. So you can see them here. They are not magic. So once you determine this, you can move further to calculate your accounting rate of return, which is the formula estimated average annual profit divided by estimated average investment multiplied by 100 over 1. For project A, the estimated average annual profit is what? 20,000 divided by estimated average investment 107,000 multiplied by 100 over 1. The accounting rate of return for project A is 18.69%, and for project B, 13,033 divided by 66,000 multiplied by 100 over 1, you have 20.2%. So the point now is this: what will be your decision? What will be your decision regarding this? The set target is what? The set target is 20%. So which of the projects is giving us a higher value? Let's see that the management expected return on investment is 20%. So which of the projects is giving us a higher value? It's project B. So projects A and B produce RRR, but project B RRR is a little bit greater than the management targeted RRR of 20%, because we have 20.2%, although approximately to be 20%. So however, since projects A and B are mutually exclusive, that is competing projects in which the acceptance of one will preclude the acceptance of the other, what do we do? Hence, project B with the higher accounting rate of return of 20.2% relative to project A of 18.69% should be accepted. So that will be the decision rule in relation to this. So this is accounting rate of return. Another word for accounting rate of return is return on investment or return on capital employed. So please, let's take note of some of these words. They are very important. So there are various ways you can compute that, but the examiner also always wants you to adopt this approach. So what are the advantages of accounting rate of return. One of the advantages is that it is simple to understand and easy to calculate, and it also considers the total profit or savings over the entire period of the economic life of the project. And one more thing is that this method recognizes the concept of net earnings, that is earnings after tax and depreciation, because this is a vital factor in the appraisal of an investment proposal, and it is useful for performance evaluation of firms or organization, because it gives clear picture of the profitability of the project. Yes, it has certain drawbacks. Likewise, it does not account for the time value of money, and it does not consider the cash flow, which is superior to accounting profit. And also, it ignores the management risk appetite, management attitude to risk, and it suffers the definition problem, as profitability can be calculated in various ways, which hence can lead to conflicting results. So it does not consider the increased risk of long-term project and the increased variability associated with long periods of time. So what you must know, get to know the formula: estimated average annual profit divided by estimated average investment multiplied by 100/1. How do you get your average investment? Is initial outlay plus residual value divided by 2, and your annual depreciation is what? Initial outlay minus residual value divided by useful life of a project. And the decision rule is what? For independent projects, accept if the accounting rate of return is greater than or equal to management predetermined rate. And for mutually exclusive projects, what do? You accept any project with higher accounting rate of return, provided it is greater than or equal to management predetermined accounting rate of return. So you can watch my other videos, as we treated the non-discounted cash flow techniques, such as the internal rate of return and the NPV, as required by the financial management syllabus. So more will be discussed and will be uploaded on the channel. Thank you very much. If this is your first time, you can comment and subscribe on the channel.